Hello, everybody. In today's video, we're going to tackle the age-old question of what has performed better, stocks or bonds? This is an area where I see clients get it wrong a lot of times and their allocations are not exactly where they should be. So we're going to analyze the tail of the tape and see who has done better. And be sure to stick around at the end of the video because I reveal the biggest takeaway from this information. I'm David Warshaw, Certified Financial Planner at The Wealth Plan LLC. Let's get to it. But first, what is a stock or a bond? Well, governments and companies need capital to grow. A stock is where you own equity, ownership of the company. Bonds are where you're lending money to the government or to the company for them to grow. Stocks represent ownership, bonds represent loanership. And there are, of course, pros and cons to each of these investment vehicles. If we go all the way back in time, all the way back to the 30s, we can see how stocks have performed against bonds. And if we look at the 30s, for example, stocks did not do the best job. Large companies lost 1.4% a year against bonds, which did 4.1% a year. But as you go through time, you see that in most decades, large U.S. companies have outperformed bonds. Notable exceptions, 70s was very, very close. Bonds did about 6.1%. Large companies did 5.8% a year. And the 2000s, that was a lost decade where large U.S. companies did not perform as well as bonds. All the other time periods, all the other decades we measure, stocks have outperformed. And since 1926, you put all these decades together, stocks have compounded your wealth at 10.1%, bonds 3.6%. And for this data, it's going until the end of 2023. So then I said, well, let's leverage the power of AI. And in my Perplexity tool, I wrote, for rolling 1, 3, 5, and 10-year time periods, what percent of the time did stocks outperform bonds going back to 1970? And if we look at the output, 1-year rolling period, stocks beat bonds 65% of the time, 3 years, 77% of the time, 5 years, 74% of the time, 10 years, 91% of the time. Well, we're all long-term investors, right? So I did another search just looking for the 15, 20, and 30-year numbers. Once you go 15 years, stocks beat bonds 83% of the time, 20 years is 97% of the time, and 30 years is 100% of the time. So these are different tools that I'm using. But one publicly available calculator is on a website of Dollars and Data. It's called the U.S. Stock Bond Historical Returns Calculator. And I just said, okay, let's go more modern. Let's just go back to 2000. Now, that's a very fair decade to start because the 2000s was a very rough period of time for stocks. The 2010s is where the stocks really picked up speed. So if we put all of our money in stocks and we started in 2000 and ended at the end of 2024, last year, well, your total return before inflation was 7.85%. If you, over the last 25 years, put all your money in bonds, you did 3.87%. So now that we've seen the data, I'm going to give you 5 takeaways of how to interpret this data and the key takeaways for you as an investor. Number 1, it's true. Stocks have decimated bonds. They've done a much better job, typically doubling the rate of return of bonds, of fixed income investments. And that's why whenever you see a long-term chart going all the way back to the 20s, stocks always come out on top, then bonds, and then inflation. The second point is that it's not always true. We saw the 30s, the 1930s, the 1970s, the 2000s. Those decades were not the best period of time for stocks, which is why my third point, you diversify. You put your money in different types of stocks, different asset classes. There's mid-sized companies, small-sized companies, real estate, international companies, emerging market companies. And for those of you that follow my channel, you know that I'm a big fan of alternative investments, right? private equity, private credit, cryptocurrency, commercial real estate, and others. So that is why diversification is so important today, because it is very likely we could have another 10-year window where stocks do not outperform bonds. By now, some of you are thinking, well, I should just put all my money in stocks, right? They have the highest probability of beating bonds. The fourth point is that may not be true for certain people. If you need money within the next 3 to 5 years, I'd say no, you should have some money in very conservative investments. CDs, high yield savings accounts, money markets, or bonds. So that's one category of people that need their money in the short term, because we saw that it's not a sure thing in every time period. The second group are those people who are retired. If you're retired, there should be a certain amount of money earmarked in a conservative bond portfolio to meet your retirement income needs. And the fifth point, this is the big takeaway from this video. I want you to understand why this is the case, why stocks in most time periods outperform bonds. Think about it. If you're looking to grow a business, and you are going to borrow money from someone and pay them 5% interest and their principal over time, the only reason you would do that is because you think you can grow your wealth, you could grow the company at a rate greater than 5%. It's just how our capitalist economy works. The second point is, no one would ever be incentivized to create a company if they can make more money just lending it out. There'd be no businesses to lend money to. So the big idea is owners of businesses typically outperform lenders to those businesses. Now that we understand that, I want to harken back to my original investment philosophy. The goal of investing is to grow your wealth faster than inflation and taxes can take it away. I'll say that again. The goal of investing is to grow your wealth faster than inflation and taxes can take it away. And what we've seen through history, with all the crises that we've experienced together, stocks have done a much better job of protecting and growing your wealth. And that is the big idea. Now, there are no facts about the future. Past performance is indeed not indicative of future results. But please keep that in mind when you're thinking of how much money to allocate towards stocks and bonds. Take care. Bye-bye.